PantheonAI presents PAI Morning Briefing for April 17th. Welcome to the PAI Morning Briefing. It's April 17th, 2025. Good morning, everyone.
Morning! Hope you're all ready. We've got a jam-packed show today, right?
Absolutely. Market updates, insights on recent trends, and news to help you navigate the financial landscape. Let's dive right in, shall we?
Sounds good. So where are we starting?
Let's start with a quick overview of the major market indexes and crypto. S&P 500 is trading at roughly 5,302.73, down by about 0.05%.
Barely moving, huh?
Exactly. Not exactly a headline maker, but investors are holding steady, absorbing recent developments. Dow Jones, however, is seeing a more noticeable slide, down roughly 1.23%, trading at approximately 39,258.
Ouch. A rough morning for the Dow. Needs a stronger coffee, maybe?
Definitely. Nasdaq's at about 16,364, showing a slight decline of around 0.21%. But the Russell 2000 is holding up well, close to 1874, showing a gain of about 0.55%.
So, investors are favoring the smaller cap stocks right now, it seems.
Looks that way. Now, switching gears to crypto. Bitcoin's trading at roughly 84,437, up by about 0.49%.
Resilient as ever.
Yep, and Ethereum's showing a bit more strength, up roughly 1.01%, priced at approximately $15.93. So traditional index is mixed, with a touch of crypto positivity.
Interesting mix. Okay, so what are the major market trends making news today?
Well, the Fed's stance is still a big one. Fed's Williams has made headlines again, emphasizing that he doesn't foresee any need to move rates anytime soon.
No rate changes in sight, huh? That's a big statement.
It is. It suggests confidence in the current economic footing and a belief that inflation is under control. It's like the Fed saying, we're comfortable here, folks.
Right. So steady as she goes, at least for now.
Exactly. And on the employment front, jobless claims have fallen to a 2-month low.
That's good news. Reassuring even.
Definitely. Despite market jitters, the labor market remains robust. No sign that trade wars are triggering widespread layoffs. Last week, the number of people filing for unemployment benefits fell by approximately 9,000, totaling about 215,000.
So trade wars aren't hitting employment as hard as some feared then?
Doesn't seem like it. It's like expecting a storm and getting a drizzle. Now, turning to the financial sector, Charles Schwab has record first quarter revenue.
Schwab's doing well then?
Their stock's been buoyed by sustained interest in trading volumes, catalyzed by market volatility. When volatility hits, everyone wants to get messy in the markets.
Huh. So volatility, while scary, is good for business for some.
Precisely. There's an irony there. Schwab's strong performance is a testament to their business model and the growing appetite for reliable and innovative trading platforms. And in the tech and e-commerce space, VERB has just closed on its acquisition of AI video commerce platform Lyvecom.
AI video commerce? Sounds futuristic.
It is. A deal valued at up to $8.5 million. This is a clear sign that companies are doubling down on AI, especially in social commerce. Imagine merging live streams with AI-powered insights.
That's democratizing how brands interact with consumers, right?
Exactly. VERB's Market.live is positioning itself to offer brands unprecedented control over their audience, content, and conversions. It's tech and commerce, making beautiful music together.
Okay, so that's the overview. Now, let's dig a little deeper into these stories.
Let's do it. First, back to the Fed's rate comments. Williams' stance on keeping rates steady is notable, given the economic uncertainties. Investors are weighing high inflation risks and robust job data.
It's a balancing act, for sure.
It is. The Fed seems confident that the economy can weather current headwinds without additional intervention. Are these steady rate signals enough to maintain your investment confidence, listeners? Or do you think we might see a shift if economic conditions change more abruptly?
Good question for our listeners to ponder. What about those jobless claims hitting a 2-month low?
That's a counterpoint to the chatter around trade wars. Typically, heightened concern over international tensions means you might see an uptick in layoffs. But here we are, with fewer people filing for unemployment benefits.
So the data is telling a different story than the headlines?
Seems that way. Are we possibly overestimating the negative impact of trade wars on domestic employment? That's another question for your morning coffee.
Definitely. And Schwab's record first quarter revenue, that's all about market volatility being lucrative for brokers, right?
Spot on. When investors are active, whether out of caution or confidence, trading volumes spike, driving revenues through the roof. It's a new normal, where volatility is an accepted, albeit unwelcome, partner.
It's like a roller coaster ride. Some feel queasy, but the ride operators are making money.
Exactly. Now, the VERB acquisition of Lyvecom, that's AI transforming business models.
How so?
It underscores the value of AI in enhancing customer engagement and providing brands with a unified approach to managing their digital presence. VERB is gearing up to lead in a space that combines live streaming, commerce, and personalized AI content. How many more traditional companies will morph into tech-driven powerhouses as digital transformation grows?
That's the million-dollar question, isn't it?
It is. Aside from those headlines, there's a steady stream of activity suggesting sound economic conditions, even amid whispers of trade tension. Job data shows fewer layoffs, and the Fed's keeping rates steady.
So the economy is quietly humming along despite the drama?
Almost. But history tells us never to be too complacent. Is this the calm before the next storm, or are we in for a long period of calm?
Another good question for our listeners. What about global market factors?
Investors are keeping an eye on the global implications of these trends. The Fed's comments have a direct bearing on domestic policies, but they also send ripples across global credit markets. And the tech sector's push into AI and social commerce is a global trend.
So it's a balancing act. How do you balance the excitement of technological innovation with potential international repercussions?
Exactly. Speaking of global implications, let's talk energy and finance for a moment. The indirect effects of trade tensions and inflation fears can send tremors through the energy sector. Rising fuel costs translate into higher operational costs for companies.
Good point. Energy's always lurking in the background.
It is. And on the finance side, consistent earnings reports like Schwab's remind us that even in volatile times, there are clear winners. Do you have exposure to sectors that could benefit from sustained economic resilience, or are you hedging against potential global shocks?
So what are the expert insights and predictions for the near future?
Well, the Fed's steady approach to interest rates is likely to continue, provided that inflation remains within target ranges and the labor market keeps its strength. Borrowing costs should remain relatively stable, helping consumer spending and business investments.
But vigilance is key, right?
Absolutely. Should economic indicators turn sour, we might see an abrupt policy shift. Regarding the job market, the current decline in filings may indicate that companies believe they can sustain high levels of employment. It could also be a sign that businesses are becoming more efficient.
Or is it just a temporary reprieve?
Worth considering. What might be the hidden risks if these numbers aren't as robust as they appear? And looking at tech, VERB's acquisition of Lyvecom signals that the integration of AI into business operations is not optional anymore, it's a necessity. Companies that adopt these technologies early on could see exponential growth.
But there's always risk with high-tech investments.
True. As an investor, balancing your portfolio to include both tech innovators and established players might be prudent. How are you weighing the potential rewards of tech innovation against the stability of more conventional industries?
Good food for thought. Any lighter thoughts on the broader economic environment?
Have you ever noticed that sometimes the market feels like a party where everyone's chatting about how quiet it is? One minute, you're expecting fireworks, and the next, it's just polite conversation. Today might feel a bit like that party. Everyone's ensuring that all the details are in place before the next big performance.
Ha! So it's better to be prepared than caught off guard?
Exactly. And sometimes, our emotions can turn even the smallest market move into an overhyped drama. But as the numbers show today, there's a consistency that underpins these markets. It might be fun to imagine the indices as characters in a long-running drama.
Love that analogy. So let's break down sector analysis a bit more.
In the tech vertical, there's an overall buzz about AI reshaping both customer engagement and operational efficiencies. This is significant for companies in sectors as diverse as retail, healthcare, and even finance. If AI can help streamline operations and offer real-time insights, it can potentially boost profit margins.
So it's not just about betting on the next big tech company, but looking at how established firms are harnessing new tools.
Precisely. In the energy sector, while today's news doesn't point to a headline grabber, the persistent undercurrents of global trade and supply chain disruptions continue to play a role. Energy prices have a way of being both a cause and an effect of market sentiment.
And in the financial sector?
Schwab's record revenue, even amid market volatility, speaks to a broader narrative of resilience. Financial institutions that adapt to change tend to weather storms better than those that cling to outdated models. Consider whether the financial sector stars in your portfolio have built-in buffers for volatility.
What about the broader global market front?
We can't ignore the intertwined nature of today's economy. Sentiments emanating from Washington, D.C. have far-reaching implications. Global markets are interconnected in ways that are sometimes hard to predict. A stable labor market in the United States can encourage overseas investment, which in turn can boost emerging markets.
So what expert insights and predictions can we offer listeners?
We're entering an interesting phase where caution and optimism must walk hand in hand. The current low level of jobless claims, coupled with steady central bank policies, suggests that the economy is on relatively firm footing. However, the potential for disruptions remains ever present.
What can we expect over the coming weeks?
In the short term, the Fed's decision to hold rates steady is likely to continue unless there's an unexpected economic surprise. Borrowing costs should remain stable, and we might see further consolidation in the stock markets. The ongoing technological revolution is set to accelerate. I'd expect the tech sector, especially companies that invest heavily in AI and digital commerce, to receive more attention from investors.
So it might be worth reevaluating your portfolio to capture potential gainers in that space?
Definitely. In sculpting your investment strategy, consider diversification. Don't forget the hidden gems in sectors like small-cap stocks, as evidenced by the Russell 2000's upward movement. And don't underestimate the role of cryptocurrencies. It really comes down to a personal balancing act.
What about the broader implications on global markets?
The synchronization of domestic policies like the Fed's rate decisions with global economic dynamics plays out in interesting ways. When the United States signals stability, it can inspire confidence across international markets. Conversely, any sign of domestic instability could lead to a flight to safety, potentially destabilizing markets abroad. Every policy decision can have domino effects far beyond our borders.
Time for a little humor, perhaps?
Have you ever noticed how market analysts sometimes treat the economy like it's a quirky old friend? Oh, dear economy, you're feeling a bit grouchy today, aren't you? And then the economy responds by surprising us with a twist that nobody saw coming. It's a reminder that, while we rely on models, data, and forecasts, at the end of the day, sometimes markets have a mind of their own. Investing is as much about psychology as it is about pure numbers.
Love it. So let's summarize the key takeaways for today.
The major indexes and cryptocurrencies are exhibiting mixed signals. Central bank communications remain central to market sentiment. Solid job market data is reinforcing the notion that domestic economic fundamentals are robust. The financial sector highlights that institutions which are nimble and innovative can turn volatility into opportunity. And the tech sector is rapidly evolving, signaling a new era of integrated digital commerce driven by AI.
So, some thought-provoking questions for our listeners.
Are you comfortable with the current market volatility? How will you balance the promise of technological innovation against the unpredictable nature of global markets in your own investment strategies? And what steps are you taking to ensure that your portfolio remains as resilient as the robust job market we're witnessing today?
Great questions! And a special shout out to PantheonAI, your information co-pilot, for keeping us all grounded with cutting-edge insights.
Absolutely. The goal here is to make sure that learning about the markets doesn't feel overwhelming. Remember, learning shouldn't feel like a full-time job.
Thanks for joining us on this deep dive into today's market dynamics. We hope you found it engaging and insightful.
Feel free to send in your questions or join the conversation on our online community. Tune in tomorrow for another episode of the PAI Morning Briefing.
Until next time, keep your eye on the trends, maintain a balanced perspective, and remember to smile at the chaos. It might just be the best market indicator of all.
Have a great day, everyone.
PantheonAI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.